Welcome to Fingraph India, and to today's explainer. Let's jump right into a classic exam scenario that trips up so many students. Imagine a business partnership is going through a reorganization. Maybe a senior partner is retiring, or you're bringing in some fresh blood. As part of this, the firm hands over a highly valuable piece of real estate to a partner. Now, no actual money changes hands here. It's just an internal reshuffle, right? Well, wrong. In the eyes of the taxman, a massive taxable event just took place. Today, we're completely decoding Section 8 of the Income Tax Act. Whether you're studying for your CA, CS, or BCom exams, or you just want a rock-solid grasp of tax law basics, consider this your ultimate guide. We're going to take all that complex legal jargon and make it incredibly simple, logical, and super easy to remember for your exams.
To really anchor our explainer today, we're looking straight at the official, unabridged text of Section 8, right from the Ministry of Finance. We aren't relying on watered-down summaries, we are dissecting the actual source material. And yeah, I know, it looks like a highly intimidating wall of legal text. It's dense, it's wordy, and honestly, it's exactly the kind of thing that makes students start sweating in an exam hall. But hey, don't worry. By the end of our time together, you're going to understand the pure, simple logic behind every single subsection.
So here is our roadmap for today. 1. Decoding Section 8. 2. Identifying the key players. 3. The triggers, dissolution and reconstitution. 4. Calculating the tax impact. And finally, 5. The administrative guidelines.
Okay, let's start with Section 1, Decoding Section 8. So let's look at the very heart of the law, specifically subsection 1. The absolutely crucial concept you need to grasp here is the deemed transfer. Subsection 1 basically states that when a specified person receives an asset from a specified entity, the entity is deemed to have transferred it. That word right there, deemed, is the hero of Section 8. It creates what we call a legal fiction. Even without a formal sale contract or any money exchanging hands, the Income Tax Act simply pretends a formal sale happened. Why would they do that? Well, think logically. Without this rule, partnerships could just distribute highly appreciated assets to their partners entirely tax-free during a reorganization, completely dodging capital gains tax. The government caught on to that loophole and basically said, yeah, nice try, but we are deeming this a taxable transfer.
Moving on to Section 2, Identifying the key players.
Who exactly does this apply to? Subsection 6A defines our very first player, the specified entity. This is basically the business that's handing over the asset. Specifically, this means a firm, an association of persons, or a body of individuals. But listen closely, because here is a massive red flag for your exams. Look at the brackets in the actual law. It explicitly excludes companies and cooperative societies. Examiners absolutely love to test this to trick you. If a private limited company hands an asset to a shareholder, Section 8 does not apply. It literally must be a firm, AOP, or BOI.
Right, so our second player is the specified person. Under subsection 6b, this is the individual who is actually receiving the asset. In plain English, this simply means a person who is a partner of that firm or a member of that AOP or BOI. So let's put the whole puzzle together. The specified entity, let's call them ABC and Associates, gives the asset to the specified person. Let's call him partner Rahul. When Rahul gets that asset, ABC and Associates is deemed to have made a transfer, and the firm itself is the one on the hook for the tax.
All right, Section 3. Triggers, activating the law through dissolution and reconstitution. So what actually activates this? This brings us to subsection 6C. The law kicks in connection with the dissolution or reconstitution of the entity. Now, dissolution is easy, right? The whole business just shuts down. But reconstitution happens in 3 distinct ways. First, a partner retires or leaves. Second, a brand new partner is admitted. And third, and you really got to watch out for this tricky exam scenario, nobody leaves and nobody joins, but the partners change their profit-sharing ratios. Imagine going from an equal 50-50 split to a 70-30 split. If any of these 3 specific things happen and an asset is handed over to a partner during that process, boom, Section 8 is immediately triggered.
Now for Section 4, Calculating the tax impact. Let's look at subsection 2 to understand the financial consequences. Once this deemed transfer occurs, how is the firm actually taxed? Well, the law gives us 2 distinct tax buckets. The income is going to be charged either under profits and gains of business or profession or under capital gains. And honestly, the logic here is highly practical. If the firm gave the partner a piece of real estate, well, that's a capital asset, which triggers capital gains. But if the firm handed over its actual everyday inventory, its stock and trade, that gets taxed as normal business profits. And remember, all of this is taxed in the hands of the firm in the exact same tax year the partner actually receives those goods.
This brings us to the absolute most critical calculation rule in subsection 3. The quote here is vital. Fair market value shall be deemed to be the full value of the consideration received. Think about it. Because this is a completely fictional deemed transfer, there's obviously no invoice or actual sale price. So what number does the taxman actually use? Actually, scratch that. What number must they use? The fair market value on the exact date of receipt. So if a firm bought a plot of land for 10 lakhs a decade ago and gives it to a partner today when its fair market value is 50 lakhs, the firm has to pay tax as if they literally sold it for 50 lakhs. If you're taking notes for your exams, fair market value is your golden keyword.
Finally, Section 5, the administrative guidelines.
Because, let's be real, implementing tax law perfectly on day one is almost impossible. So subsections 4 and 5 act as bureaucratic safeguards. Here is the natural administrative flow. Step 1. If there's a genuine practical difficulty in applying these deemed transfer rules, the board can step in. Step 2. With the prior approval of the central government, the board issues official guidelines to smooth things out. But Step 3 introduces some strict checks and balances. Every single guideline issued must be laid before each House of Parliament while it is in session, for a total period of 30 days.
And this is all about Parliament retaining total oversight. During those 30 days, both houses can agree to modify the guideline or just annul it entirely. If it gets modified, it only takes effect in that new form. However, the law explicitly states this happens without prejudice to the validity of anything previously done. What does that mean in plain English? It just means if the tax department already acted on the guideline before Parliament struck it down, those past actions remain legally valid. It prevents total administrative chaos while fully respecting parliamentary power.
So, let me leave you with this final, provocative thought. If your partnership reorganizes tomorrow, are you truly prepared for the cost of a deemed transfer? Let's do a quick revision recap of our golden rules. First, it applies to firms, AOPs, and BOIs, but never companies. Second, it triggers on dissolution or reconstitution. And third, the tax is always calculated at fair market value. Understanding this underlying logic is exactly what separates a rote memorizer from a true high-level tax professional. If you found this explainer helpful for your exams or your practice, please hit that like button, share this video with your fellow commerce students, and make sure to subscribe to Fingraph India. Don't forget to press the bell icon so you never miss our future Income Tax Act updates. Keep learning, keep analyzing, and we'll see you in the next explainer.